Okay, good morning to everybody. Today is the 4th of November, and we are going to begin talking today about Chapter 10 in the e-text, which deals with property, plant, equipment, and also intangibles. When we think of these items here on the balance sheet, remember we're sort of covering the balance sheet. One of the things that we can say about intermediate accounting is beyond sort of covering once again some of the basics of some of the principles and concepts in accounting. We're also sort of doing a sort of a deeper dive or walk around the financial statements. And so we're certainly doing this here on this course with regard to the balance sheet. So we're going to talk about PP&E, property, plant, and equipment, and we'll get to intangibles. I don't think we're going to get to this today, but we certainly will, I think, by Thursday. And this is a relatively short chapter. It's interesting. There's a lot going on here. And so as I've been pushing due dates back, I didn't do it for this one here. If you have trouble with this, let me know. We can maybe on a one-off basis, kind of deal with issues. But well, for the most part, I would like everybody to do the Chapter 10 quiz by Friday. Then you got homework in the bonus. It's up to you if you want to do the bonus by Sunday. So Chapter 10 deals with essentially long-term assets. And so we're still on the asset side of the balance sheet. And remember, as I mentioned in a couple of prior videos, that we're really covering the balance sheet for the remainder of this course and sort of taking a deeper dive into these categories. We talked about current assets last time. We talked a bit about the idea of how to deal with receivables and how to measure them, how to report them, how to create allowances for sort of doubtful accounts and whatnot. We're going to sort of move further down the balance sheet here and talk about property, plant, equipment. And that's mostly what we're going to get to today. And when we come back on Thursday, we'll talk a bit more about what some of the other topics are that are germane to what's happening here. So this is the due date for this, and I will kind of deal with the due date for Chapter 11 and 12, or 11 and 13, I should say, as we get going. Let's just see how things go in terms of timeframes. Also, Chapter 18 dealing with shareholders' equity. We're getting closer to the end of the semester, so we've had 2 exams already. And by the way, I'm about halfway done grading the first exam. I really apologize. I know I'm really delinquent and behind on those, and so I will definitely get those knocked out this week. But again, as I said earlier, if you really are just trying to know how well you did, just give me a call. We'll do it together. I'll do a Zoom call and I'll grade it. If you have not gotten your score back yet, most of you have. Not all, and I'm still working on those. It's actually not that easy because the balance sheet is a bit of a tricky thing, and sort of sorting through some of the way people have formatted things. I try to give people the benefit of the doubt, but as long as I can understand what it is you're doing, that's good. But it really is on me to get this down, and I will. So that's what's going on there. Exam 2 should have been auto-graded. And if you have any questions about that, feel free to reach out to me as well. So, okay, so let's get to Chapter 10, dealing with long-term assets. And so property, plant, equipment, and intangibles. We're not going to really get to intangibles very much today, but let's talk about the types of assets that what we're talking about here. So what is it that we're talking about when we're sort of going down the left side of the balance sheet, right? And again, accountants will refer to balance sheets as being left and right. Mostly because I think from historical experience, a lot of companies would present a balance sheet that they would mail out to shareholders, or a financial statement they would mail to shareholders, annual report. And the left side would have the assets on the one side of the fold-out page, and the other on the right side would be liabilities and stockholders' equity. So, but left, right, or top and bottom, whatever you want to call it, it's still the same presentation. But we're moving down toward the bottom of the left side, or the asset side of the balance sheet. We'll get to the equities side, that is liabilities and shareholders' equity, a bit later. So what are we talking about here? We're talking about property, plant, and equipment. We're talking about land, buildings, equipment, machinery, furniture, computers, vehicles, desks, things like improvements to the property, fixtures. I mean, the list goes on and on and on in terms of what we usually call these fixed assets. And they're fixed in the sense that they're maybe not fixed in place, because like an 18-wheeler is not fixed in place, it's moving around, but it's fixed on the balance sheet for as long as it remains an asset of the organization itself. So as a result, we call these fixed assets. It's a term that's not used as much anymore, I guess, because PP&E sort of replaced that. But being that PP&E's been around as long as I've been doing this, which is since the 12th century. So those are some examples. Now let's talk a bit about natural resources. This is where it gets a little bit more tricky. We'll get to oil and gas, timber, and mineral deposits. That is the extractable industries, and how do we deal with the accounting for those assets? And we're going to get to some of this today because it's a little bit trickier. And by the way, this is really not going to give you all the information you would need in order to go serve a client with oil and gas deposits or timber or whatnot. But it just is a bit of an introduction as to how to do it. And remember, this is an intermediate accounting course, which is giving people it's the gateway to the accounting profession. But we're talking about things that open the door to further exploration. And certainly this issue is important. And by the way, oil and gas, and from my background as a tax accountant, this part of the country, well, we have a lot of oil and gas going on here. And a lot of investors who are passive investors who may invest in a publicly traded partnership or something will have a K-1 on their tax return. And I know this is not a tax course, but some familiarity with what's going on with oil and gas, or timber for that matter, would make sense. And then we'll talk a bit later, not today, but about patents, copyrights, trademarks, franchises, goodwill, and that is the idea of intangible assets. Intangibles are those things which don't have a physical substance, but have a legal basis that gives the owner of that patent or copyright or whatever it is the right to do something. So as a result, there's a legal right that gives it an asset. And it meets every definition of what an asset is, something which was acquired as a result of past transactions, which has future service value. So as a result, patents and copyrights and all that do have future service value. And so as a result, we log those in as assets, okay? All right, so let's get into it here and see how far we can get. We'll sort of try to get through the rest of this on Thursday if we can. So PP&E, we have an example here of the Semtech Corp. The following is a summary of property and equipment at cost less accumulated depreciation. Remember, accumulated depreciation is presented on the balance sheet as a contra asset. It's a cumulative value that picks up all prior depreciation. And so as a result, it reduces the value of the asset to which it refers. And every contra account references some account and brings down the value of that account. And we have other accounts called adjunct accounts, which raise the value, but we're not there yet. In fact, I think some of that goes into intermediate too. But so in this case, what we're really talking about here is the idea that property, plant, and equipment. What do we have? We have 2 years going on here. Year end being January 29th, January 28th. Now, by the way, you might think, well, why are these two different years or two different days of the years? And it could be that the board decided it's maybe the first Tuesday after this third Monday or whatever. I mean, who knows? There's a reason why companies would choose that. Usually trying to isolate the busiest season of the year so that you're not splitting the fiscal year into two different pieces, so you can sort of capture that, particularly in a seasonal business. And I have no idea what Semtech Corp does. It's a hypothetical company, but let's take a look at it here. So we have property, plant, and equipment. Let's just take a look at 2018. We have property, buildings, leasehold improvements. Let's talk a bit about leasehold improvements. This is something that I don't believe we got into at all. I don't think, at least in 2110, the introduction course. The accounting thing is a bit complex, and it's a bit beyond what we're doing. But a leasehold improvement would be something like you're leasing a property and you're going to put things in that are improvements that actually belong to the lessor, not the lessee, which is the company that's doing the leasing. But they put them in for the convenience of their clients primarily. One big one that I can remember when I was still in banking at the time, and we had a commercial client that was a huge law firm, and they were in a building that was built like in 1850. I'm not kidding. It's old. Wooden floor, wooden everything, and they wanted to put an elevator in, and we tried to explain to them, okay, if you do that, you're going to lose the title of the elevator, because at the end of the lease term, it's going to go back to the owner, because that's what a leasehold improvement is. And they insisted they had to do it because they're on 3 floors in a very old building. But that was a leasehold improvement. But it's capitalized as an asset. And by the way, when we use the term capitalized, we're saying we're putting it on the balance sheet as an asset and saying this meets all the characteristics of an asset, that whether it's depreciable or not, is irrelevant. In this case, this would be the elevator, but it's an improvement And most of them are, frankly, because there are things like sprinkler systems, handrails. After the ADA, the Americans with Disabilities Act, we saw lots and lots of investment in leasehold improvements on the part of tenants who didn't own the property, but were putting things in like ramps for wheelchair accessibility because it was sort of mandated by the law. Things like handrails in restrooms, wider restrooms, wider doors, that is, to accommodate wheelchairs and walkers and whatnot. And so as a result, leasehold improvements were really, really ramped up during that period. So you're going to see this if you become an accountant, you're going to see a lot of leasehold improvements on the part of clients that are there. So in this case, we have this, and we can depreciate it. We'll talk about the depreciation issue a bit later. We have machinery, equipment, construction in progress. That's something that we are going to get to a little bit later here. And we have accumulated depreciation and amortization. So this is just a sort of snapshot, a fragment of a balance sheet as of the fiscal year end for 2018 in this case, okay? So that's what's going on here. So let's talk a bit about, here's an example here of the Walt Disney Company. We have some other areas. We're now going to intangibles, and so we're sort of dropping in. We're going to come back and talk a lot more about intangibles a bit later. In this case, it's Disney. And so what's the value of the franchise intangibles and copyrights? Okay, so this is the area where it's a little bit difficult. I mean, when we talk about intangibles, these are not physical things you can put your hands on. You can't move them around, put them on a truck or whatever. Instead, they really represent intellectual property. They're legal rights to things. And what's really interesting, I know that a lot of my accounting students really loved it about 2 years ago, I think it was, in 2023, where the rights to Steamboat Willie expired because they were 100-year-old rights. And now Steamboat Willie is, which was a Disney creation from Walt Disney himself, the man himself, and it went away. But we're talking about very long lives of some of these, particularly when it comes to things like franchises and also things like copyrights. And we'll get to those in a bit later. So this is an example of what's going on. Licenses, trademarks, all these are assets. And even if you're talking about smaller businesses, sometimes things like liquor licenses can become assets because of the fact that they represent an intangible asset and they're relatively scarce. And so as a result, we have to kind of understand what's going on. So this, I don't want to go through line by line of this because I'll let you read this for yourself. But here are the examples of PP&E that we're talking about here: equipment, land, improvements, buildings, natural resources. And then what is the description? Well, we kind of know what the description is. And by the way, most of these are depreciable with the exception of land. Land is never depreciable because land is thought to never go away. And so as a result, land does not depreciate in value. And remember, when we talk about depreciation, what we're saying is it's a cost allocation method. It reduces the value of some asset because it wears out over time. You buy a delivery truck and it's going to last for, 10 years or whatever. Maybe it'll last for 8 years, but you're going to write it down over that period of time because of the fact that it's a losing value. But it's not really what's going on. What we're really doing is we're allocating the cost of that asset. It's really a prepaid asset. We're buying a delivery truck. We're going to use it for several years. It's not that much different than prepaying insurance, except for the fact that insurance is going to get reduced in a much quicker basis than as a fixed asset like a delivery truck. But it's the same concept. And so this is one of the things that we try to emphasize to students is the idea that why are we capitalizing these assets and why are we depreciating them? We're depreciating it in order to spread out their cost. Does it approximate market value? Probably not. I mean, often not. And this is where we get into differences between book accounting and fair market value accounting. We're going to get to that a bit more in this particular chapter, in the idea that we depreciate an asset, but we may be overly depreciating it or under depreciating it, whatever the case might be, relative to the fair market value. But that's not really the point. We're trying to spread out the cost. And hopefully, at the origination of the acquisition, we are estimating it correctly, but we don't really know. And things can happen. And so as a result, these are imperfect estimations. But we make a lot of estimations in accounting, and that's kind of the territory here. So we talk about equipment, land, improvements. We talked a bit about whether these are improvements to one's own land, and we're talking about things like driveways and fences and grading and sloping and things like flood control, where you're trying to put slopes onto land so that that any kind of standing water kind of gets drained away and whatnot. These are all improvements to the land, all of which will be capitalized. These all become part of the asset itself. Okay, so it's important to know that these improvements are separate than the land itself. These are different. Buildings obviously doesn't really require much explanation, and natural resources we're going to talk a bit more about because there's a lot going on here, and so we're going to talk with respect to natural resources. Okay, and we get to intangibles, and so we're sort of dropping our way down here, and this is sort of a preview, a lead into where we're going in chapter 10 here. So what about intangibles? These are assets that lack physical substance. We can't put our arms around, we can't, necessarily put it on a truck and move it and whatnot. We talk about patents, typically a 20-year patent. This time frame has been elongated, particularly for prescription drugs, and the drug industry has been very successful in getting a longer time period by which they have a longer, essentially a monopoly pricing power over in the market for the particular drug that develops. And if you've ever watched TV, and I suspect all we have, we're inundated with drug ads, all these different drugs, Eliquis, and I mean, I don't even know what they do, right? So I'm kind of glad I don't have to take them, right? But all these different drugs that are out there, and they're all under patent. If they weren't under patent, they wouldn't be advertised. But they really want patients to talk to their doctor. Hey, I want this drug. I want Eliquis, or I want this kind of thing and whatnot. So, and there's a premium price. There's no doubt about it. Nobody can argue about that. So that's and patent law is complicated. By the way, patent law is sort of a catch-all sort of wraparound phrase that encompasses a lot of these intangible assets. And one of the things that I have learned from just dealing, I knew a patent lawyer once who told me very explicitly that if you don't defend intellectual property, then you are essentially forfeiting it to whoever wants to take over that. So whether it's a trademark, which is maybe a brand name or a logo or a slogan or whatever, if you don't defend it, then someone's going to come after you and take it away. And you really don't have a leg to stand on. So defending it makes sense. And by the way, the defense of that, which often involves legal fees, gets recapitalized back in the asset itself. Not expense, not a legal fee, which is expense, but part of the asset itself. And so, again, this is welcome to the world of accounting and how we do some of these weird things here. Copyrights deal with things like this is pure intellectual property, musical recordings, painting, sculptures, and whatnot. And they really belong to the owner itself, and has a fairly long life. Franchises, I think we're all familiar with franchises. The one that sort of comes to mind, which we all, I'm sure, know about, are fast food franchises, where people buy the franchise itself, which is a right to sell Big Macs and quarter pounders and whatnot. And but it's an independently owned business. A lot of people I don't know if people realize it or not, but a lot of these McDonald's and Carl's Jr. and KFC, they're really not owned by the company. Some of them are, but not all, and some of them are owned by independent investors who simply own that business as a franchise unit, and they have to kick up a franchise fee based upon revenue and probably a fixed fee annually. But that's essentially what's going on. Is the idea there's a franchise. It's based upon some brand, and once people get and branding is important. And I'm not a marketing person, but branding is one of these things that attracts the demand side of the market. So to that extent, it becomes valuable. And I have seen many people. I think I talked about the fact that for whatever reason, I had a lot of physicians who were clients back in the day who bought McDonald's franchises and Burger King franchises. I don't know that those are the most healthy places to eat. These were medical doctors, but they were investments to them. And so as a result, this is a way to invest in a business that is way bigger than one's own self. And then goodwill. We'll talk about goodwill. Goodwill is a complicated issue, and it's changed in terms of its accounting treatment over time. Goodwill is not something that cannot be generated internally. It's got to be acquired. And what it really represents is simply a mathematical reflection of the price paid for assets over and above the book value of those assets. And as a result, we book that as an asset called goodwill. Now, goodwill can be impaired. We used to amortize, that is, bring down the value of goodwill over, I think it was 15 years, as I recall. We no longer do that, but the goodwill can be impaired And I don't know that we get into impairments just yet here, but impairments are where an asset is no longer worth what it was. And so we got to sort of write that down. So that's a quick and dirty issue there. So cost to be capitalized. All right. So let's talk about these, the PPD as well as intangibles. We'll get to intangibles a bit later here, but what are we really talking about here? So it can be acquired by purchase, self-construction, donation, whatever kind of combination, or exchange, or lease. I do want to talk about leasing. I think it's important that we talk about that because it's a really important means of fixed asset financing. But it means that a company can acquire either and put it on the balance sheet or not put it on the balance sheet, depending upon the type of lease. And so the initial cost of the purchase price, plus all the other necessary expenditures necessary to bring its condition to its desired use. This is not anything different than, say, like inventory, for instance, right? The definition is not really that different. It's whatever it cost us to acquire the asset, whatever it is, and any kind of expenditure necessary to bring it to its market usefulness is therefore becomes part of the asset price or cost that we put on the balance sheet. Remember, we put things on a balance sheet at the cost of those goods, and then we keep them there. Now, whether we amortize them or depreciate them depends upon the type of asset. But in this case, we're simply saying this is the initial capitalization. Again, capitalization referring to the idea we're putting something on the books as an asset, and we're going to use it going forward. Okay. So when we talk about the cost of something, we're talking about the purchase price. And so what are these categories here? It's purchase price, obviously, sales tax, if it applies, transportation cost. If the buyer pays it, remember, we got into a bit of this discussion about freight in versus freight out. If you're the acquirer of goods, assets, right, and you're paying the freight costs, those freight costs go into the cost of the inventory itself or the asset itself. Actually, it's not really inventory here. It's because we're moving further down the balance sheet, but it's the part of the cost of goods itself. So transportation costs go in there. Testing, installation, we got to that. Any kind of legal fees and whatnot. All these are represent the initial amount to be capitalized. And capitalized simply means recorded as an asset. That's really all that is going on. Okay. So here's an example. Central Machine Tools purchased industrial equipment to be used in its manufacturing process. Purchase price was $62,000. They paid a freight company $1,000 to transport the equipment to its plant plus $300 shipping insurance, which they paid. Okay. In addition, the equipment had to be installed and mounted on a special platform built specifically for the equipment. Well, that's part of the usefulness of the asset, is to get the asset ready to be used. We're not talking about inventory here. We're not talking about displays. Those are current assets, but it's analogous to that idea in the sense that we're trying to get this good ready for use. And so we got to get it set up. We got to create the infrastructure surrounding it in order to get it to be used. And that's going to cost $1,200. After installation, several runs were made to ensure operation. And the cost of these trials include wasted materials of $600. We could argue a bit about this last one, but for the most part, we add up all these costs and we say the value of this equipment, whatever it is $65,100. It's not $62,000. It's all the other things that attended its ability to be useful to the company. Because remember, an asset has to have future service value. It can't have service value if it's not set up to run properly. So testing, maintenance, and installation, insurance, freight in, all these kind of things are elements of the cost of the good itself. Those are all as a debit balance to the asset account itself. So we should be aware of what's going on there. And by the way, all of these are what's depreciated over time, right? And you might think, well, why are we depreciating the cost of freight over, I don't know, 10 years or whatever it is? We don't know what the useful life of this is. Well, and that's just sort of the logic of how financial accounting works. Yes, can we expense it? We not in a GAAP we couldn't. Should we? Well, that's an open argument, and there are a lot of arguments that accountants have over things like freight and very short-term sorts of cost, of whether they should be capitalized as a long-term cost of long-term assets. And so it's a little bit beyond what we're doing here, but nonetheless, I'm just simply telling you what the rules are. The GAAP rules are, we would include those. We would capitalize those costs. It's part of the asset cost debit balance account, and we go forward. And in this case, it looks like it's a piece of equipment, so I cannot imagine it's not going to be depreciated over time. Okay. All right. So here are the following expenditures related to equipment purchased by Symington Corp. Purchase price $48,000, transportation cost, installation, special wiring. So what will they record as the purchase of equipment? In other words, what will the debit to the equipment be? It's all those things, 57.9, which is 48,000 plus 2,400 plus 1,500 plus 6,000. All those go into the asset price. And so as a result, our cost to the buyer, remember, price is more of the exchange value in the market itself. Cost is the internal value. So to the Simonton Company Corporation, this is the cost that they're going to put on the books, 57,900, and that's the amount that's going to be depreciated. And if and when that asset is exchanged, sold, whatever, it's going to form the original basis. And even if we depreciate it, it's going to form the original basis by which any gain or loss is going to be recognized down the road if something happens. We sell it or exchange it or it gets lost or whatever the case might be. We really don't know what this asset is, but it doesn't really matter. Okay, so that's the accounting for the cost of equipment. Okay, all right. So let's talk. There's nobody on the call. It doesn't look like so. Yeah, I see nobody there. So I would ask other questions, but there's nobody here. So let's talk about land. And what's land all about? Obviously, so I mean, it's sounds like a ridiculous question, but we're talking about unimproved property for the most part, just land as we know land to be. And what goes in the cost of it are things like the purchase price, which is pretty fundamental, plus any attorney fees that we pay, we as the buyer, not the seller might pay, but we as the buyer. Remember, we're putting assets on the books, and so we're the acquirer, we the firm itself, right? So we're going to, any attorney's fees we pay, any real estate agent commissions, although a lot of places, those are mostly paid by sellers. So you may not see this a lot on the acquisition side, the buying side. Usually realtors charge sellers. Any cost related to title and title search. So title insurance is something that I'm very, very familiar with. It's simply the idea that you can buy a piece of property, but how do you know that the seller has legal title to the property? Which means if they don't have legal title, how will you have legal title? And we're talking about property that, and I come from back east where property's been turned over, a lot of times, and who knows who owns the property, and sometimes the surveys are not very accurate and whatnot. And so, in order to sort of educate, which means you really don't know where your property boundary ends and where the other person starts. It sounds completely crazy, but it happens all the time. I bought a house in a subdivision where we were kind of unclear as to where the property boundaries were. Not that it was a big deal, but we kind of wanted to know. And the surveys were sort of accurate, sort of not. But that's an example. So why do you buy title insurance? You buy title insurance in order to protect yourself against to ensure you as the buyer have legal title. And by the way, if you're financing the purchase, the lender will also have its own policy, usually issued by the same company at the same time. And title search is simply the means by which we get to. If you don't want title insurance, you can just do a title search. That's nowhere near as comprehensive as title insurance, but nonetheless, you get the idea. Recording fees, those are fees to local localities in order to record this. And any bank taxes, liens, and mortgages. This is not uncommon whatsoever. In fact, I bought a property once that was moving its way towards state or I guess county for tax foreclosure. And I simply paid the back taxes and I acquired the property, but that became part of the cost of the property itself. So if I ever sell that property, I will have to include that, which is good because it raises my basis and it reduces the ability or my chance of paying capital gains tax along the way. But any kind of back obligations are paid. And so what happens is a lot of times as we go through time, property taxes are levied on all real estate, pretty much everywhere. There are a lot of states that don't have income taxes: Texas, Florida, Washington, Nevada, a lot of those states, Maine, and whatnot. But they definitely have property taxes. And in the state of Texas, I can tell you, and they've been a banker there for a couple of years, property taxes are pretty high. They're pretty high in Texas. If you don't pay them, then the state can foreclose or the locality can foreclose on you. And if you want to acquire the property, you got to make current those things. And so that becomes part of the purchase price of it. Now, theoretically, the purchase price will come down because you have a distressed seller, but nonetheless, these become part of the cost itself. the cost, which becomes part of the asset cost. Now, with land, you can't depreciate it, cannot depreciate it because land is not depreciable. But nonetheless, all these are examples of things that go into the cost of the good itself, including things like draining and whatnot. And I talked about the idea that sort of moving dirt around, changing the grades, installing drainage systems, sprinklers, fences, sidewalks. All these are examples of part of the cost of the land itself. Distinct from any structures that are on it, structures are going to be depreciable, okay, over time. But land itself is not depreciable. Having said all that, one final thing is land can be impaired if there's a problem with the land itself. But that's a little bit beyond what we want to do here. So here's an example. The buyer's structural metal company purchased 6-acre tract of land, an existing building for $500,000. That was the total price. The company plans to remove the old building, right? Construct a new one on the site. So in addition to the purchase price, which was $500,000, the company made the following expenditures at closing: title insurance, which was the owner's insurance that they're paying for, commissions to a realtor of $16,000, and property taxes. And some of this was attributable to the seller because they were delinquent. $2,000 is attributable to the buyer because property taxes tend to be paid in advance. And so in this result, so the buyer, even though the buyer hasn't entitled yet, they're going to pay ahead of time. So, and they're going to pay $10,000 to take down the old building, move it. So excavation costs become part of the cost of the land itself. So it's very common that you buy a piece of land and the structure on it just simply is no longer useful. It's just decayed. It's outdated. It doesn't make any sense. Let's take it down. And especially in agricultural properties, we got things like silos and barns and things that have been around forever. Sometimes you just got to take those down, and that becomes the cost of it. And I certainly saw this in my own family's experience, where a lot of farmland was being sold to developers building, houses and condos, and they did not want the barns and silos and chicken coops or whatever. So they would pay to remove those, but that would become part of the cost of the land itself. So, all right, so here's the initial cost of the land. So $500,000 was the sales price, but that we're not done yet. So we have title insurance, $3,000, commission $16,000. Delinquent property taxes, only $4,000 of those belong to the buyer itself because of the fact that $2,000 are going forward. So those become not capitalized expenses, but just ordinary income statement expenses. Property taxes are an ordinary cost of doing business, and so they're expense, not capitalized. In this case, we're talking about old costs, which become part of the purchase price. And so as a result, $4,000 goes to that. And you might say, well, why does that? So why are we treating these differently? Why does one go to the balance sheet as an asset? Why does one go on the income statement? Well, a lot of it has to do with the fact that, first of all, theoretically, I guess, if you were going to pay someone's back taxes, you would theoretically, I guess, lower the purchase price offered to them in order to absorb that. I mean, does that make sense? Right? You're going to pay someone's back taxes or whatever the case might be. So theoretically, you're going to lower the purchase price, and so as a result, the purchase price will be reflective of that. And whether that's true or not, whether that relates to any other buyer in the market value, really doesn't make any difference because there's really no way to know. Remember, we put assets on the books based upon their cost, and this is one of the costs of acquisition. And then remove the old buildings. This is an excavation cost and the cost of grading. All that goes into it. So $538,000 is what goes on to the asset side for the initial acquisition of land. Okay, and the thing about land is it cannot be depreciated over time. So as we put that on the books, we know that we're not going to be depreciating. It's going to stay there forever. And I think I've told this class that sometimes these land holdings go on for many decades, and if it's a business entity that's doing the reporting, we're still reporting with the cost of acquisition, $538. Maybe the property's worth, I don't know, $7 million in 20 years. Who knows? But we're still going to carry it on the books at $538,000. And there's nothing to depreciate. I guess maybe the improvements, maybe the cost of grading might be argued as an improvement that can be depreciated, but we're talking about small change here. And in terms of how we interpret that, is that an improvement or is that a fixture? or is that part of the cost of good itself? It's part of the land. It's not going to be depreciated. So, and we're going to carry in the books that whatever that cost is, cost which includes all of those. So this leads us to the next topic, which is really interesting. It's the idea of land improvements. So these improvements are separately identified. That is, we're separating these out from the cost of the land itself. So what do we and we're going to depreciate them. And why are we doing that? Because they're really not part of the land itself for a very long time periods. Theoretically, the accounting concept is land never goes away. It's going to be here forever. Which is not a particularly wise assumption if you're in certain low-lying parts of the world, like Amsterdam or Venice or Miami. Even we're seeing Miami falling below the water level in some cases, but that's the assumption that's being made. And by the way, if you do fall below that line, then we do an impairment, and we could an impairment loss. But that's a subject for another day. So I just want to let you know that there is a way to kind of deal with that. So let's talk about improvements. What are they? Well, these are all these things like fences and improvement and pavement and sprinklers and fences and grading, all of which can be depreciated because of the fact that they have a limited useful life, and they're going to probably have to be replaced at some point. Okay, particularly fences. Fences isn't really a big. There's so much depreciation of fences just because of the fact that a lot of owners want to separate the property from other owners, particularly in areas in which you don't want people crossing over on the property and whatnot. So it really serves as a sort of a walling off of that particular property. But that fence itself is not an expense; it's an asset, and that asset is depreciated. How we depreciate that is really based upon what the estimated useful life is, and we could do a couple of class sessions just on estimated useful life. But what we're really saying is, what is the best estimate for how long this fence is expected to last? And therefore we capitalize that cost. And we have this separate account for a fence, right? Separate account. And if we have a sprinkler system, we have a separate account for that. We have all these kind of things, and we depreciate separately. It might not show on a balance sheet because of the fact that we're sort of aggregating these together under PP&E. And for a public company, which we tend to focus on here, you can sort of drill down into the financials if you want in order to get to that. And if you really don't get enough satisfaction, I suppose you can contact the company itself and say, what are these improvements that you're depreciating? And what is the basis of those? Maybe they'll reply to you, maybe not. But those are the GAAP accounting standards require that we would depreciate those separately. All right, buildings, not much different here, other than the fact that these are typically have a longer useful life than fixtures or improvements. So we're talking about the cost of acquiring a building. It's all these things we've talked about before: purchase price, any realty commissions. Yeah, they tend to be paid by the seller, but sometimes they can be split between buyer and seller in some sort of negotiation. Remember, real estate transactions involve buyers and sellers who are negotiating price and all the other terms, legal fees that are paid in order to acquire the property. It is often the case that sometimes lawyers are required. I know that Dave Ramsey, the big financial counselor on radio, has long talked about the idea of bringing a lawyer to closing. As a banker, I can tell you, do not bring a lawyer to closing. No one's saying don't hire a lawyer, but don't bring the closing. All the work needs to be done ahead of time. Closing is the point at which we're there to do one thing: to sign. That's it. If you need a lawyer to sort things out, fine, hire a lawyer. No one cares whether somebody hires a lawyer or whatnot. But those legal fees become part of the cost of the building itself, if you want to do them. And a lot of times there are legal issues that are involved with acquiring a property. If it's a house, not so much. I don't think you need a lawyer in most jurisdictions in order to handle that as the buyer's agent. In the southern states, lawyers handle closings, but that's not what this is. This is legal fees that become part of the cost of the good itself. Okay, become part of the cost of the good itself. And also anything that needs to be done in terms of remodeling or whatnot in order to bring it up to speed. So remember, this is, again, I hate to sort of draw parallels that don't make sense, but I think this does make sense. It's just like we bought inventory, and we got to get up to speed in order to be able to use it. And the inventory is a current asset. The use is to be sold. Well, in this case, this is a fixed asset, long-term asset, but we got to get that up to speed. And so that becomes part of the cost of goods. So in both cases, we're absorbing cost into the asset itself that are necessary to get this good available for use. In the case of inventory, obviously it's to be sold. In the case of a building, it's to be used for whatever purpose it is that we're buying the property. And so hopefully we have an idea in mind as to what we're going to do with it. So, all right. So I'm going to ask questions, but I know there's nobody here. So if you do have questions, feel free to get with me. More than glad to talk about that. But let's get at natural resources. So natural resources accounting, I have got some experience in this area. It's really a special area of accounting. It really, really, really is. And if you don't deal with natural resources very much, it's going to be an area that a lot of professional accountants sort of find themselves on sort of quicksand here, because there are some rules that apply that are sort of difficult. But in this course, we're just going to talk about some of the basics. And from there, if you get into some tricky situations going forward, you can kind of deal with it. As I mentioned earlier, as a tax accountant in this part of the country, and if you want to be a professional accountant, or especially a tax accountant, you're probably going to run across clients who are going to have oil and gas properties. And so you kind of got to know a little bit of the lingo as to what's going on here if you want to be able to serve your client adequately. So we talk about natural resources. What are we talking about? Timber, minerals, coal, oil and gas, and whatnot. And the benefits are derived from their consumption, but that's further downstream. So we know they have value. Obviously, nobody needs to explain why oil has value or natural gas has value. It's got value. And so we talk about the cost of it. If it's purchased, it's purchase price plus any other cost necessary to bring that asset to condition, which means things like any wells drilled, any tunnels that are created for mining, for instance. I guess we have a lot of mining in New Mexico. I know we certainly do in Arizona. And my grandfather was involved in the coal business for many, many years. And that's how I sort of got familiar with natural resource accounting, and just simply because he had so much oil, not oil, I guess, but coal deposits that, and all the things like drilling shafts and all that become part of the cost of the asset itself. If it's developed, that is, we don't really know. And we need to talk about exploration versus, acquiring a proven reserve. You have things like acquisition costs, first of all, which tends to be in the form of a lease. These drillers, these extractors. By the way, we call these the extractive industries. All these timber, mineral, coal, copper, whatever, and acquisition costs may be in the form of a lease. In which case, at the end of the lease, the lessor goes away, right? Exploration costs, development, all that go into the cost of the good itself. Okay, so there's a lot of different elements here. We're going to sort of focus on what are some of the basics with regard to this, and that is the idea of how do we recognize as an asset the cost of these goods? Because remember, with all assets, we want to put these on the books at whatever they are. Okay, and we'll come back. And we'll sort of circle back a bit more to oil and gas and minerals and whatnot. Timber, all these are extractive industries, and just it's sort of ironic that I had a grandfather who was involved really not just coal, but also timber and whatnot. So, and he's been gone for quite a long time, and I'm sort of the only one in my family who has a business background. So I'm still dealing with some of these complicated issues, but it's fine. I'm trained to do it, so it's fine. So, but I do have some familiarity with it. So, all right, AROs, asset retirement obligations. What are these? Well, first of all, these relate very definitely to primarily, I think, to extractive industries, where at the end of the termination of whatever this obligation is, that something has got to be involved in restoration. What are these restoration costs? So as an example, all right, let's say, and I'll just give you an example from my own life, right? Where my grandfather acquired X number of acres, I forget what it was, knowing there were coal deposits underneath, and he leased the property to Amex Coal, which is strip mining. They just go back and forth, back and forth, back and forth, and just sort of and go all the way down hundreds of feet deep in order to withdraw the coal. But at the end of the day, they've got to make that property back to what it was before. So they're going to refill the dirt, and maybe they're required to plant trees and whatnot to water it. And by the way, sometimes you would not know that there was an extraction that has gone on there 10 or 20 years prior, because they do actually do that. But here's the thing: how do we do the accounting for what's called an asset retirement obligation? That is, This is an asset that is not of a infinite life. It's going to expire at some point. And so that whatever the legal obligation that's going on here requires under GAAP that we have to recognize that up front, both as an asset as well as a liability. If the value can be reasonably estimated, and if it cannot be reasonably estimated, we have to do the best we can, because we know that we got to put a debit and a credit going on here. There's an asset and liability because of the fact that at the end of the day, and the end of the day, maybe 10 years, 20 years down the road, whatever it is we're doing, we have to recognize the fact that there's an obligation in order to restore this asset back to something like what it was before, which is why a lot of times these assets are leased. And when we talk about leases, it's an area that is sort of near and dear to my heart, but we're not really going to get to here. But what we are talking about is the idea that we're a retirement obligation that we need to satisfy. And so the sum of all these costs are what is depreciated over time. So we talk about standards to address these. We're talking about scope, recognition, measurement. Present value, which gets us to the idea that we have, and it's not present value of an annuity, but present value of some sum. And we'll do a little bit of math here if we have time, and talk about how we recognize the present value of something now, which obviously the present value is discounted from what its future value will be for a lot of different reasons, and we'll talk about that. So these are some of the standards that are involved in. So here's an example. Jackson Mining, and this is a similar case that's presented in your text as well. And we can talk about that. So Jackson Mining paid $1 million for the right to explore for a coal deposit on 500 acres of land in Pennsylvania. Cost for exploration was $800,000. So obviously exploration costs are large. Intangible development costs incurred in digging and earthing the mine shaft for $500,000. In addition, and by the way, the mine shaft may come out at the end of the day. We don't really know. In addition, Jackson purchased new excavation equipment for the project at a cost of $600,000. After the coal is removed, the equipment will be sold. Okay, so we're saying this particular equipment is going to be gone at the end of the day. So it's required by the contractor to restore the land to a condition suitable for recreational use after it extracts the coal. Not an unusual situation. And it doesn't have to be recreational. It could be commercial. It could be residential. It could be whatever the case might be. It could be municipal. You would not know sometimes that coal has been taken out of the ground and it is gone. I mean, believe it or not, it just is. And in fact, maybe the land's safer now because there's no coal underneath it, right? So we have three different possibilities, okay? And this is where we get into this idea of probability weighting, okay? So one, we have a cash outflow of an A, option A, 500, or alternative A, 500,000. There's a 30% probability of that. 600,000 in option B, and a 50% probability, which looks like it's probably the winner here. And C, 700,000 at 20%. So these numbers go up, and the percentages also change. Now, where do these numbers come from? Well, it's best estimates, right? This is what we would call the weighted probability, the probabilistic cost of something, right? And we're also going to discount it at some rate of interest. In this case, we're saying the risk-free interest rate, which kind of brings us into more finance courses. When we talk about risk-free, we're talking about the lowest rate on the safest debt instrument out there, which is usually treasuries, which would match the term of this thing. In this case, 8% is obviously way high given today's environment. But let's just kind of go with the example. The rate is 8%. Okay. So what are we doing? We're going to take this times this, right? This times this times this. And I'm going to sum those up, and we're going to get a dollar figure that's going to represent the cost of these renovations or restorations that are going to happen at the termination of this project, however long that is, and hopefully we know how long it is. And so, all right, so let's do the math here. So the cost of the acquisition is $1 million, exploration of 800,000, development cost 500,000. Here's where we get into the issue. Restoration cost of 468,360. Where did that come from? Well, we did the math going back here, and again, where do these percentages come from? Well, we're going to assume management knows what they're doing here, right? And these are the probabilities. By the way, this idea of weighted average probabilistic estimation is not unusual at all in accounting and finance. We do it all the time. And it's not to say that these estimates are right always, but hopefully they're informed by past experience, as well as with an eye toward what's coming down the road. And so as a result, this times this times this, and summing all these guys up gives us an idea of what the cost is going to be at the end of the day, knowing that we don't have to pay it yet because it's X years down the road. So let's add these guys up here and we get 500,000 as 30%, 150. 600,000 as 50% is 300,000. 700,000 as 20% gives us 590. And here's the thing: it's going to be at 3 years down the road. So N is 3, I is 8. Where did that come from? It comes from the present value tables that you can find all over the place. And in fact, I probably should have pulled it up here, and I did not. But let me see if I can do it without wasting a lot of time here. But in your textbook itself, and in fact, I think that, let me see here. I think we have this here. So we should all be familiar with present value. This is not present value of an annuity. This is for present value of a lump sum. So I think it's on page, where is it here? 479, I believe. So let's go to the text. Let's pull this up here. And so, shoot. Present value table. I think it's toward the back, actually. So present value. This is, all right. So we go to the appendices, and we have present value, future. Here we go, right here. So this is present value. This is future value. Let's go to present value because we're going to discount this. And what were the numbers here? It was N equals 3, I equals 8. So let's go N equals 3, I equals 8, and the discount rate is 0.79383, and that's the same number there, 79383. All that is simply the present value interest factor of the lump sum, right? And that is a lump sum because we're not paying anything over time. If we were, it'd be an annuity, it'd be a different calculation whatsoever altogether. But all we're simply saying is we think 590,000 represents the cost of the restoration at the end. In other words, the heir or the retirement obligation. And so as a result, we don't have to pay it yet. It's not due for 3 years based upon our estimation. So N is 3, N is the years, I is 8. Where did that number come from? Well, we would expect that hopefully it's an informed number that makes sense based upon this. And we kind of are leaving accounting here going more into finance. But the key thing is we take the sum of these times 0.79383 and we get 468,360. That becomes part of the asset cost. Boom. That is the cost of this particular project, right? At the initial acquisition. So we put on the books 2,768,360. Okay. And that's the amount that we're going to be using as we go forward in order to understand what the prices are. Oh, by the way, I don't think I brought this over here. I was doing it I apologize for that. So I had it on my screen, didn't have yours. So 3 years, 8%, and we got to 0.79383. This is on page 479 in the e-text. And I apologize for that. So I was looking at my screen. I didn't bring it over for you, but that's where we got that. Present value of a lump sum, and it's the number of years. And if we were going to chop it into 6-month periods, we would simply do that. We would take 6 divided by, if it was 6 years, or it was every 6 months, we would take 3 times 2 is 6, and we would chop the rate in half. We get the very same thing, right? In that regard. And by the way, it's going to be 0.79383, and that's the math. We're going to discount the future value, the future value paid today. Now, what are we going to do with that? All right. So we know this is part of the acquisition cost. All right. We know that this is the amount paid in the future that becomes part of the cost now. So as a result, we capitalize the upfront purchase price plus exploration plus development plus restoration. We're assuming this is all going to happen within this reporting year. So what do we do with that number, that 2 million, or that 468,000? Well, let's talk about what's going on here. So, all right, so here's the amount. So we're going to put on the coal mine, total cost, we're going to debit coal mine, 2,768,360. We're going to pay 2,300,000. What? 1 plus 800,000 is 1,000,008, plus 500,000 is 2,000,003, and the restoration costs, which become part of the liability itself. This is so this is the credit balance, which balances out the cost of the asset itself, right? So we have an outlay of cash now to pay for that, but we also have this termination cost, this exit cost, because it's basically restoring the property to whatever it needed to be. And we see this in so many different industries, where warehouses will, buy, 20,000 or lease or buy or whatever, they get 20,000 acres of land, and they'll cut down trees and they'll replant new trees, right? That's part of their obligation. Asset retirement obligations almost always, not always, but almost always deal with natural resources extraction and recovery. And the idea is, and it's good business for Weyerhaeuser or International Paper or Amex Coal or whomever to kind of restore the land. In the case of timber, what's really interesting is the idea they plant new trees, and so that becomes new things to harvest in the future. So it really is sort of an investment. But you get the idea that we have to account for it up front, and we have to then treat this in subsequent periods. And this is what we're really going to talk about, this amortization of this particular amount. And that's kind of what we're going to get to here. And hopefully we'll get mostly through the discussion today. So, all right, so that's the cost of the. So in other words, here's the debit to credit, debit to coal mine cash, and the asset retirement obligation. The equipment is something separate. it's weird they kind of include that as something, but I guess we pay cash $600,000, and this is not part of the land itself because it's a separate asset. If it can be used in other projects, then it really belongs elsewhere. Even though this company believes this asset's going to be used up and going to be terminated at the end of the project cost, that's up to them. And maybe their experience will be different, better, worse, who knows? But that's what they're thinking earlier on. So when we talk about reducing this 468,360, which is different than the amount of 590, we have a discount amount here that we need to write off that we call an accretion expense. Okay. So what is accretion expense? Accretion expense is simply, it's separate from depreciation. It has nothing to do whatsoever with depreciation of any structures or any equipment or whatever. It's simply the reduction of value. It's a form of amortization to bring this thing current. So we book this at year 0, which is the purchase date. At the end of year 1, we're going to simply say 8% times this is going to be that, and we're going to add that to the balance. So 468,360 plus 37,469 gives us the new obligation of 505,829, which at the end of year 2, we take that times 8% is 40,466, which we add to that balance here to get us to 546, and we go on and on until we get to, at the end of year 3, 590. And this is not some accidental math. We knew we were going to get there simply because of the fact we were simply going to take these amounts times the discount rate. This is what we call the effective interest method. We see this particular method applied all over the place. We could take the difference between 590 and 468, which is going to be what, 121,640 divided by 3, and just chop in 3. That would be the straight line method. That would not be the preferred method that we would use. We instead want to use the effective interest method if we believe the 8% is the effective rate that we want to use. And it's what we call a discount rate that we bring down the value of the asset, or in this case, the liability, by the amount, because the amount's not due yet, right? So in the first year, here's what the entry is. We recognize the accretion expense, 37,460, and we add and we reduce we add the liability. We don't reduce. We add. Remember, we're both a liability at 468. We're ultimately going to pay 590, so we got to add to it over time, and it's not even. If we were in a straight line, it just simply take the difference divided by 3, it'd be the same amount year after year after year. In this case, the effective interest method is what we're going to use. So as a result, we're going to debit accretion expense. That's a current year income statement item, and we're going to add it on the credit side to the liability itself. And so this is part of the obligation that the extractive industry firm is, or the firm in the extractive industry is required to fulfill. But we're going to recognize over time, and as we get to it, we'll recognize that full amount at that point in time, and hopefully everything will balance at that point. So in this case, here's the journal entry. We have an asset retirement liability. At the end, this is at the end of the day, remember we had a $590,000 liability that we're going to debit, and if there's a loss for whatever reason, because maybe we ended up paying more, and this is not uncommon, This is not uncommon at all where, remember, these estimates ahead of time, that's what they are, as estimates. We really don't know. And I would expect probably a loss more than a gain. I mean, I think if you have a gain, which will go on the credit side of this, that's probably a happy circumstance, but probably we're talking about a loss. In this case, 590 was our original obligation to recover and restore things to their prior situation. In this case, it cost us 35,000 more, which was simply debit as a loss, and it goes into the accounting statements as the income statement in that year as a loss. And so as a result, we paid 625, not 590. I guess theoretically you could have a gain, and that is the case where maybe the expected costs are not commensurate with what we thought initially were going to be the case. And if that's the case, I don't think anyone's going to be irritated about that. Nobody dislikes taking a gain. Okay. All right. So we talked about, so a quick check here. We got about 11 minutes to go, and we're doing pretty well on time. And I think we're going to make a good dent in what we're doing here. If I had to do a supplementary video later in the week, I'll do that. But let's talk about the cost of land. This is a quick reference check here. And so the Winder Old Mining Company paid $50 million for the right to explore and extract copper from land owned by the state of Wyoming. So $5 million. So we know $50 million is going to be there. And to obtain the rights, Winder will agree to restore the land to a suitable condition for other uses after its exploration and extraction activities. And they incurred costs of $15 million in the project. And we're assuming the discount rate here. And again, let's not worry about where that number comes from. Let's just assume that it makes sense. I mean, how we determine that is a bit beyond what we're doing here. Let's just assume 6% makes sense. So we have a cash outflow of $5 million, and this is at the end, right? This is the retirement obligation. We have 40% probability, 10 million, 60% probability. So what is the initial cost of copper mine? Well, we don't get 50 million right there, right? And we don't get more, and we also have exploration and development costs of 15 million. So we know it's going to be at least that, right? Plus we have this asset retirement obligation at the end of the day, which is how many years? Well, it doesn't matter here. So here's the answer. So the expected outflow is going to be this. All right. So if you take this times this, 5 million times 40%, which is $2 million, right? Out here. 10 million times 60% is $6 million. 2 million plus 6 million is 8 million. So that's the outflow to be expended down the road, just based upon this math, right? 5 million times 40%, or 5 million times 0.4, 10 million times 0.6, we're going to 8 million. Okay. And the restoration, but the restoration costs don't happen until, I guess that's 3 years, right? So it's 3 years down the road. So 6% and 3. So n equals 3, I equals 6. Let's go back to if I can find it here. So n equals 3, I equals 6. And you're going to get a discount rate of 0.83962. Is that what we have here? It is what we have here. So 8 million times 0.83962. We discount it because it's not due yet. We didn't pay this for 3 years. It's going to give us 6,716,960 based upon that issue. So all the costs then, let's go back to the original condition, 50 million for the purchase price, 15 million for the development costs, exploration, that's 65 million, plus that 6,716,000 gives us 71,716,960. That is what gets debited under the cost of this particular project, whatever it is, right? And usually they have some name to it. And by the way, when we talk about publicly traded companies, particularly mining and whatnot, they'll sort of lump on the balance sheet, they'll sort of lump these all together. And so it's not just one project, lots of different projects. And if you want a further breakout of what's going on with each individual project, the notes may have some explanation of that. And you have to sort of tear into it. But remember, on the balance sheet reporting, it's oftentimes very much consolidated. So you just kind of have to sort of work through that and figure out what's going on. But you can always ask. And if you're an investor, the finance department of the company can oftentimes help you out with sort of explaining what are all these asset figures, because they're not always all that well explained, because some companies will have lots and lots of different projects all around the world. Okay. All right, one final thing. We got about 8 minutes left in this, and we do want to get into intangibles and talk a bit about that. And we're going to sort of talk much more about this as we come back on Thursday. So, what about intangible assets? What's going on here with these guys? What are intangible assets? So, intangibles are these things which, at the outset, I mentioned, don't have a physical substance. They really represent property rights that are legal rights that don't have anything to do really necessarily with any other asset. They don't really have any interaction with them, but they do derive value. If they didn't have value, nobody would pay more for them. And by the way, I should have pulled this up, but I know my 2110 class, I pulled up a chart that showed the growth in intangible assets over time and how sometimes intangible assets are really greater than some of the more tangible assets like current assets and property, plant, equipment, and whatnot, to the point where it's oftentimes a very large portion of the balance sheet on the asset side. And this is surprising to a lot of people because I think the mistake we don't want to fall into here is they think intangible, therefore it's less relevant. It's the minor leagues and whatnot. It's just the leftovers. It's the scraps. No. The reason it's further down the balance sheet is because it's less liquid. Remember, we order things on the balance sheet in terms of liquidity, and these items tend not to be very liquid. And it's not just the fact that maybe there is a limited market on the demand side for these. It's the fact that maybe the company doesn't want to sell these. I mean, why would Disney want to sell Snow White or whatever? I mean, or Mickey Mouse or whatever the case may be. I mean, why would they want to do that? That's kind of what they're in business to do, right? So it might not make sense. Or things like, why would Coca-Cola want to do away with its slogan, the real thing, right? Which is not maybe in use that much anymore. But why would the company want to part with that? So as a result, these have value, but they're very slippery and they can be transferred from one party to the other. There's no question about that. At a gain or a loss and whatnot. But here, what we're mostly interested in is valuing these and what do we do with these over time. So intangible assets, again, we talked about what some of these are, and we need to talk about the difference in terms of whether they have a finite life or an indefinite life. And in other words, if it's got a finite life, we're going to amortize it over a period of time that makes sense based upon whatever the useful life is. If it's got a finite useful life, a patent, for instance, has a finite useful life. You've created a drug that deals with, I don't know, weight loss or diabetes or whatever the case might be, right? The patent's going to go away. And by the way, the patent date, I think, starts at whenever the government approves it. So it could take a while to get this thing into market, but there's an X number of years by which that company's got the patent on that particular good. Now, what tends to happen is that the millisecond after that patent expires, everybody else has got identical drugs, and sometimes they go hit the over-the-counter market. Things like Dimetap and Claritin and Claritin. These were all prescription drugs at one time, and but for the short time in which they're restricted, limited, where there's a monopoly pricing power granted by the government that we're going to find that useful life. But with that value of that, we need to amortize it over time based upon the remaining estimated useful life. If it's indefinite, we don't amortize, we just put it on the books and we leave it as an asset. And here's the thing, you might think, well, so it never depreciates, it never amortizes, never goes down to zero and whatnot. Well, it might if it's impaired for whatever reason. And this is where we recognize the impairment loss. We debit the impairment loss as a debit, and we credit the asset itself, which brings down the value of the asset if we find it's been impaired. But for the most part, we're talking about legal rights. They don't have a physical substance, right? So patents and copyrights, trademarks, these are things that have a limited life, and so we're going to write these down over a period of time. But there are some things that have an indefinite useful life, and as long as the owner of that keeps renewing it, then it stays alive forever, right? So things like logos. And as I understand it, I mentioned earlier that if you don't defend it, you're sort of ceding the ground to those who are conceding this to another party. So it does make sense for companies to enforce their legal rights to these assets. Okay, so we're talking about tangibles. I don't want to go through this. This is a long slide here, but we're talking about different things: patents, copyrights, trademarks, franchises. We're going to talk about all these individually as we get going here and talk about what they are. Particularly, the big thing is interesting is the idea of patents, and patents include the purchase price itself plus any kind of legal fees, which is important, any kind of legal filing fees and whatnot. But we're not including R&D. This is important because not including R&D, not including R&D, not including R&D, not including R&D. And research and development costs have never really been accepted by FASB as being an acceptable cost to capitalize. And one of the reasons why, and I know companies have fought this for years, really to no avail, but one of the reasons why is the fact that companies are developing all kinds of things all the time, which may never come to fruition. So you're inventing some drug to, I don't know, cure cancer or whatever. I'm not a scientist, I don't know, maybe curing, I don't know, breast cancer or whatever, and it never comes to light. Well, how can you put that onto an asset when there is no asset because there's no good to sell? So you have to expense these as they're going. So R&D costs are expensed as they're incurred. They can't be capitalized. And from a tax standpoint, that's fine because you get to write off the cost as they're going, but it doesn't raise the value of the asset itself because there may be no asset. You may not have a drug that cures breast cancer or whatever the case might be. It's not just, I mean, I sort of gravitate back to the drug industry because it's such a huge part of our economy. And when we think about patent law, a lot of it has to do with these drugs that are being developed. And I'm sure we all watch television and we're inundated all day long with these drugs that do all these things, sometimes dealing with these strange conditions that nobody ever heard of. But I hate to laugh, but I mean, we're sort of inundated by it. But R&D costs are not part of the cost itself. And it's controversial. Companies really would like to capitalize them, but nonetheless, they are not. So as a result, no. And here, there's really nothing in terms of R&D because it's a franchise. You're buying a KFC franchise. There's no real R&D going on. You're a wealthy person. You want to pay $2 million for a KFC franchise at Montgomery and I don't know, whatever. There's nothing that you're going to be amortizing with regard to that. Franchising is interesting. It's a huge part of the economy, and it's one where a lot of people think that these businesses are owned by some corporate entity somewhere. In fact, that the distribution is handled more locally by franchise owners, and so having known lots of franchise owners over time, it's an interesting business. And there are a lot of things we can say about franchises, about some of the challenges, but also the opportunities involved in that. So I think we're going to stop there. So it's 11:45. I'm going to stop here. I'll pick it up on Thursday, and we've got a little more work to do. I know we're not as far along as what I had hoped, but I do think we kind of take this as it goes. I'll probably do a supplementary video probably Friday afternoon, something like that, in order to sort of give you a little bit more detail, particularly as we sort of move our way down the left side of the balance sheet. So, and again, if you have questions for me about anything, I am available. I'm here Monday through Saturday, so feel free to reach out. I'm more than glad to help you with what's going on, and I will see you all on Thursday.